Okay, sorry for the delayed start, everyone. Just had a few technical issues, but good afternoon to everyone, and a really warm welcome to our event today on VC trends in Western Europe. So this event is brought to you by KBC and King's Alumni Angels, which is a community interested in the intersection of angel investment, entrepreneurship, and research. KBC is the largest student-led business society in London, and we regularly run events such as this one for anyone interested in the world of business. And we're very fortunate today to have two great speakers with us, Dan Adler, partner at Adler Ventures with M&A experience in the technology sector, and Dr. Alexander Kern, principal at AKX Capital and a managing partner at the Euro Institute. So before we get into our session today, I would like to quickly outline the schedule. So shortly, I'm going to pass over to the speakers for their kind of presentation today on VC trends in Western Europe. And I would like to emphasize the opportunity for everyone to ask questions in the chat throughout the session. And we're going to have a little bit of time at the end for a Q&A, which will be a great opportunity to get any questions answered by our two speakers today. So without further ado, I'd like to hand over to Dan and Alexander. If they could just give us a brief introduction of kind of career opportunities and breaking into VC to start with, that would be great.
Who should start? Dan, myself?
Go for it.
All right. Yeah, so hi everybody. Thanks guys also for having us here with you. Well, career advice on how to break into VC. There are two traditional ways, I believe, how we can get into VC. One is like through the traditional way through corporate finance. You're going the traditional way from like the traditional university, potentially the Ivy League schools, to like one of the investment banks. You have like a certain background in knowing how to invest in certain businesses. You move from maybe more into private equity, and from private equity, even further into venture capital, as that's a niche of private equity. That would be like, let's say, like the typical CV type of way of breaking into venture capital. On the other hand, I think one of the way more exciting ways, and Dan, correct me if you see it differently, is coming from the space of being an entrepreneur, having successfully led a number of businesses. For example, I had the case, I'm working with a number of venture capital firms together. One of them, they had exited a cybersecurity company to Google a few years back. They were investing afterwards, like more as an angel investor in a number of startups, had been seeing that growing very well, but wanted to move that from the pure, let's say, angel type of investment into more like a venture capital type of investment, finding additional investors, like limited partners, how they are called, who are investing into their venture capital fund, and they build up a particular strategy, which I've been helping with. And once that strategy is set up, there are LPs, there are limited partners, there are investors essentially in the venture capital fund already. You are starting the fund. And those people are not running their fund alone, so you need like certain partners. So you are picking the like from the industry, like people who had like successful other exits, or being successful entrepreneurs, or being in startups themselves, knowing how they are running, having a certain industry expertise, and are finding a job in a venture capital firm. Dan, do you want to add something to that?
Yeah, sure. I mean, I agree with you. I think there are two routes, as you mentioned. One is through the more corporate finance route, and the other is being an entrepreneur. I personally, to give kind of a little bit of introduction myself, I actually started my career as a lawyer. I was at Cliff Chance for a number of years, but already then had kind of a very strong focus on technology, and was bringing in kind of early stage startups, giving them cheap and cheerful legal advice, and had an unusual focus on the industry. Headed the Israel team there, which obviously has a very strong tech ecosystem, and then moved across, as Alexander mentioned, to investment banking as kind of a route into VC. So moved across to Lazard, which allowed me to make the step across to VC. And I think maybe for those watching or who are kind of less familiar with what goes in to being a VC analyst or even up to partner level, I mean, the basics of it is to have a real passion for technology and an interest in different companies and what you're seeing. But there are a few fundamental building blocks, I guess, which you need. The basic one is being able to read and understand financial statements, being able to analyze a company, the merits of it, and its growth opportunities. The second one, and this is probably why we've seen so many founders go into venture capital, is the operational side of it. So being able to help the startups, once you've invested in them, actually grow, have a value add beyond just the monetary value you bring. So really, I think that there are two parts of it, and we can talk a little bit more about it as we go through the conversation. But I think really there are two types of partners and two types of VCs. One which is very focused on the financial side of it, so understanding the company, looking at the metrics, investing on that basis, with a general understanding and diligence on technology. The other is being able to say, right, this is a certain type of business which I know really well, and I know how to take it from where it is today to where I think it can be in 3, 4, 5, 10 years time. And yeah, I think that's the unique perspective which probably founders who founder turned VC have, which some simple financial people like myself maybe lack.
Maybe I can add there something to it, also to answer a little bit the question which was on the previous slide, actually, what is venture capital? Like, I think it's really important to understand here, when venture capital is much more like risk capital, you're going to invest in like some crazy people with crazy ideas, and as an investor into them, you also need to be I'm not saying crazy, but there is something crazy about it, because most startups are failing. There are those typical statistics of like 9 out of 10 startups are failing, and I believe that that's not even the truth. Those are the startups which made it to a level that they get into a statistic. There are many before that which don't even get to that level. So you actually need those crazy people, those investors, which believe they understand the market, and they either understand it because they're coming from a financial industry here and they can make the predictions and the forecasts, or much more, and that's what Dan said, and that's where my connection now, are people who really understand clearly the technology and what is behind it and what the potentials are in terms of building that business. So venture capitalists, besides that they are just giving like growth capital or risk capital, really good venture capitalists also try to give a hand in order to grow the business by having a certain industry knowledge, which maybe some other people would not have, which would be purely like so-called dumb capital, like people just dropping money into startups without helping them because they don't understand really where the value in the business is behind.
And with regards to kind of, sorry, don't mean to cut you off.
No, I was just going to add very quickly two minor points. One is, I think something which is worth mentioning is, if there are any people on the line who have very specific degrees, or specific expertise, it may be in physics or science or another science, whatever it may be, those are very, very attractive to VCs because they allow you to understand technology and those types of businesses a lot better than someone who hasn't had that education. So although we've been saying kind of it's financial people and founders, I think there is definitely a third category, which is finding those niches which your expertise lie in, and there are certain VCs who will look for those kind of people. I think the other thing worth mentioning is just to differentiate a little bit between some of the investments that Alexander mentioned. So, for the early stage seed investors, where it's you're investing very early in a business. That is kind of what people perceive as venture capital, where you are first money in, or you know, or in the seed round, or sometimes pre-series A, and really it's just an idea at that stage. You're starting to get very early traction. That is very much a case of, yeah, you have to be a little bit crazy to do it. I think as you get a bit later, so Series B and beyond, it becomes very, very similar in terms of the thought process and the diligence process that you'd see in more traditional private equity, because there the idea has been proven out, the traction has been proven, the business model has been proven, the go-to-market has been proven, and now you are investing to give them the fuel they need, to give them the firepower they need to really execute on that and to grow that to the next level. So I think when we talk about at-risk capital or extreme at-risk capital, yes, it's still slightly riskier than a fully fledged, stable business at that stage, even at the later stages, but it's still a very different risk outlook to investing in early stage.
I think that's actually a good point to continue with that slide, because we are talking here of different also risk profiles and where you can really make your returns. And typically, like the high VC type of returns are made in the seed stages, like investing in really early stages. That's where the higher returns are, but it's also a risk reward, which is logical, because in that moment, and you're giving money to not proven concepts, and not proven teams, and not proven business models, and pretty much nothing is proven. It's sometimes just the idea with a little bit of development around it. So I think for that reason, it's actually very exciting to be a venture capitalist, because you see a lot of exciting new ideas growing. But also from a financial return point of view, and that links to this slide, actually venture capital has been outperforming over the last 10 years, for example, the S&P 500. While if you go to later stages, Series B and following ones, the ratio is not anymore suddenly that good. Still, it's very good, and it's a very interesting investment class, but it comes also with the moment that in those later investments, you actually, as a, let's say, average person or a smaller VC firm, often you don't have chances to enter it, because then you have the big VC firms, the big names, the Sequoias of this world taking the tickets, because the startups want their names on their balance sheets or in their cap tables, to be precise. While at the earlier stages, like angel investors, which really believe in the team, or early stage VC firms, which are much closer maybe to the team, to the product, and they are capable of still like shaping a little bit in which direction the startup is going.
Yeah, and just to bring that to life a little bit, maybe with a couple of stories or companies which I personally have been involved with. So one very early stage one, pre-seed one, first money in, which I did, was Free Trade, which just announced around this week a £69 million raise. I knew Adam from Canary Wharf, realized the need for a commission-free stockbroker, had seen the success of Robinhood, or early success in Robinhood in the States, and had a great belief in Adam's ability to execute on it. Based on the round this week, that was a 47 times return on the first capital in. You can't achieve that in any other asset class in the world. To give you another example of kind of one very recent one is a business called Arbe in Israel, which does chips for next generation autonomous vehicles. That was one which was almost 3x in the space of 6 months, because it managed to SPAC within 6 months of us doing the investment. So, and Arbe was a much later stage one, but you see the difference in returns between one you invest in pre-seed or seed stage where you can make 50x returns, and one you'll do later stage where you're looking at 3, 5, maybe best case 10x.
Well,
if you'd like to touch a bit about this slide here about what startups don't know about venture capital, and delve into this a bit.
Yeah, I think actually on that slide there's a bit of misleading picture with having Google on it being not anymore the average type of startup, to be honest here. But what I think is very important for startups to understand is the business of a venture capitalist. A venture capitalist is not only there to be your friend, to be honest. I mean, even though there are many good venture capitalists which try to help the startups, and that is also great to portray, but still a venture capitalist is there also to serve the needs of his or her LPs, their limited partners. Who are the limited partners? Those are actually the investors into a venture capital fund. And they have obviously certain expectations, which are actually financial returns. So in that moment, like venture capitalists are looking for like ideally exit or like some fast, let's say, track record success, and potentially after 3 to 5 years, some sort of money backflows in order to serve also or the investors, depending on the fund strategy, if they reinvest the capital or have already some capital flows back to the investors. But typically a venture capital fund also has like a lifetime of plus minus 10 years, so some up to 12 years. Some try to be a bit faster than that, but on average you can say they are all around about 10 years lifetime. And those people are there to help the startups. I don't disagree with that, but they are also there to serve like their limited partners' needs. So therefore, you need to really understand what the business of the venture capitalist is. And also, if you are as a startup, you want to raise capital from a venture capitalist, you need to understand clearly what that venture capital fund is actually investing in. Which stage are they investing in? Early seed stages? Is that really their focus? Is that what they understand? Are they rather investing only in later stages? Because I know a lot of startups, they are applying to like VC firms, which they see on some lists on the internet, but they might be the ones which do only like Series C or later stages. So therefore, well, you need to find a match as well of the industry the VC firm is looking at, as well as the growth stage of the startup you're looking at, in order to really develop synergies and have really the potentials that the venture capitalist is investing in. And you're making the life of a venture capitalist easier if you're having a clear pitch with a clear structure, which is easy to understand, understanding the business model, and therefore they know relatively fast, does that startup fit to us, or is that simply not a fit? Might be still a good business, but there's just no match at that point.
Yeah, and if I can just add a couple of things. First of all, very, very valid points, and I agree with all of that. I think one other thing which is really important for founders to know, or startups to know, is that most VCs will be reviewing thousands of pitches a year, right? And you don't get that much time to make a good impression. And generally speaking, although VCs will say they're very, very thorough, and we do as well, the reality is you are making an investment decision within 10 minutes, and the rest of the process is basically validation for your decision. And there'll be many processes where you come up and you see actually something is not right. Maybe the growth isn't as it seems, or the market isn't big enough, or the product isn't quite what you thought, and you won't go ahead with it. But anyone who doesn't pass those first 10 minutes, I think it's very, very difficult to recover from that. So, thing for startups to bear in mind is make sure that you get your most important, most impressive information right out at the front in a concise way. The other thing I just want to mention, which I don't think we've discussed, but it's probably important for anyone who's listening with an interest in VC, is that there is actually a kind of third type of VC which we haven't discussed. I think we talked about the founder-led ones and the more financial ones, but there's also what's called the CVCs, so the corporate venture capitals. And this Google picture kind of jogged my memory to it. So Google, for example, have Google Ventures. Samsung have Samsung Next and a separate corporate venture arm. Now, these are slightly different to the structure that Alexander described, because they're not serving multiple LPs, they're not serving any investors into the fund. They are there solely to service and for the benefit of the corporate which is funding them. So, AXA Ventures, for example, are there to invest in primarily insurance-related products, which can be of benefit to AXA going forward. So it's just a kind of route into venture capital, which is non-traditional, but is definitely worth considering.
Great.
Maybe one more factor about like venture capital is to understand also like how the business of the venture capital is built up. Like, what's the business model actually behind the venture capital fund? Because I think that's often also forgotten, and startups often don't even know about it. Like, a venture capital fund is raising money from other people, from high net worth individuals, family offices, or institutional investors, such as insurances, pension funds, etc. And for managing that capital, they get, like, on the one hand, the performance fee here, which is traditionally somewhere like 20% of what the fund is doing in terms of performance. And they get like a management fee, typically 2% of the capital they have under management. And what you need to see is there are a lot of like first-time VCs coming out there, micro VCs, or like second, third-time VCs, which still don't have maybe a lot of money under management. It might sound for a lot of startups like they are humongously big because they have like 10 to 50 million under management. But if you see the fee structure, they are sometimes struggling themselves if they have a number of employees, a number of partners who need to live out of those revenue streams. And I'm not going to make out the numbers in detail for you, but you can make them yourself. It's a tricky business. So they are sometimes struggling with their core business, which is similar as the one as of the startups, which is actually raising the money for the fund, and the investing comes afterwards. So, or the business of the VC is first of all setting up the fund and raising the money to their own fund, which they can later deploy, which creates the revenue streams. So they need to build the infrastructure themselves, and the infrastructure is basically the legal structure, but at the same time, even more important, and really the capital in the fund, which they can deploy into the startups. So which is maybe one of the other reasons why you need to understand what a VC is really focusing on. And the focus might not be, especially of the smaller VCs, only on the startup investment side, but also developing their own business model themselves. Dan, I don't know what you think about that.
No, I agree with you, and I think it's important to bear in mind that process can take 12, 18 months, and it takes up a huge amount of VC time. The other thing, I guess, which is worth mentioning is, as a result of the fee structure and everything you mentioned, actually VC, particularly at the earlier stage of your career, is not the best paid option. As compared to other careers in finance. I think generally speaking, the salaries are probably 30, 40% lower than you'd expect in something like investment banking or law. But where it really does pay off is on the carry. So VCs will take 20% of the profits on any deal. And given the returns we just mentioned, if they've made X million pounds, often the employees there benefit from the carry as well. So that's where it becomes very, very attractive, but that's more of a long-term bet rather than a short-term salary gain.
But which is, I think, at the same time great, like, because you are really achieving there like alignment of interest between the employees, the partners, and to some extent also the investors in the end, because all are profiting out of the success of the VC and ultimately the success of the startup and the innovation, and not only taking out certain fees out of the business, which the money is better used in the business to grow the business.
Yeah, and I just saw a question, I think, isn't carry generally only for senior employees? The answer is generally yes. It depends on which fund. Generally yes. But if you think about your life in the fund, assuming you work your way through the ranks, at senior associate principal level, that's when you'll start getting the carry, and it increases with time.
If you just want to touch quickly on the future and kind of the trends we're seeing across VC, and I don't know if you want to share your screen, Dan, up to you. Just kind of the future trends we're seeing, and then we'll jump into the Q&A after that, because I think there might be a few questions.
I mean, sorry, Dan.
No, I was just going to try share my screen. I think I can't do it while someone else is sharing the screen.
I can, in the meantime, maybe answer while Dan is getting that new presentation up. One of the questions also in the chat about sustainability and what the future of VC looks like. I see lately there are trend that there are a lot of VCs coming up which try to have like a let's say impact investing feature in it, which means like they are looking for startups which having a sustainable angle. They want to change towards like a circular economy. Yeah, I even have seen VC firms which are unlike others traditionally, which are looking much more at the exit and doing like smaller investment tickets on the ongoing basis, but rather saying, okay, we do like a rather bigger investment ticket at the beginning until the company turns into a profitable business model, which is before venture capital was much more looking into growth, and you have seen like all those like startups and talks about Uber being not profitable, Airbnb not being profitable, Facebook, Amazon, whatever. Meanwhile, most of them are turning profitable or have turned profitable, but for a long time they weren't. While there is like a new niche in the VC space where they are looking much more in building profitable business models. What I find kind of interesting personally is like having a combination of trying to find businesses which are having a profitable angle in it, but still have the upside of a scalability in it. I find that's an interesting niche, and it seems to be more and more explored by venture capitalists.
I agree with that. I think ESG, impact investing, is the huge trend now in VC. We're going to see much more of it. It's becoming much more prevalent in the public markets, at the large corporate level, and ultimately younger startups, growth companies follow the trends that they're seeing in the wider market. And you know, we're seeing a huge amount of impact type startups and also, you know, specialist impact VCs. I think what's also an interesting factor is from an investor perspective. So, you know, the LP perspective, they are looking at funds which specifically are focused on or have some element of impact in them. So, you know, when people go to that fundraising process, it's very helpful to be able to say, actually, I'm doing some impact investing as well. So I think we're only going to see it grow. It's a huge growth area. We see everything from electronic charging and all of that. I mean, we did a super exciting one of my favorite companies in our portfolio called YCharge, which is an Israeli wireless power company. So if you imagine a transmitter on the ceiling, which is transmitting power via infrared to all of the devices in the room, and that technology works, it's out there, it works. You know, their basic device is 40 foot, but the Israeli army asked them to trial it for 140 meters, and they managed. So Yeah, there is incredible technology, and if you think that does away with the need to ever have an AA battery and all of the non-recyclable waste that comes with it. So yeah, I think Alexander made a really valid point, which is the impact investing becomes interesting where there's an upside to it, right? And that's where we're really going to see an influx of capital. And we're seeing those types of companies, which, like Wide Charge mentioned, there are many, many others that I can talk about who have a real impact, but also a huge upside, at least to the extent that traditional VC companies would. To jump into the slides a little bit, and I'm not going to focus too much on the numbers, but I think we were supposed to talk about kind of trends in Western Europe. I mean, we are primarily UK and Israel investors, albeit we do invest in elsewhere as well, including Western Europe. From a UK perspective, venture capital has absolutely boomed. We're now third in the world, only behind the US and China. The VC investment here is more than that of France and Germany combined. It's pretty much, it's almost as much as the rest of Europe combined. And so we're in a huge boom here, and I think that's only speeding up, not slowing down. They're talking about kind of wider Western Europe. Germany, Berlin in particular, has seen a huge acceleration as well. France, from a governmental level, is putting huge resource into backing VC in the startup ecosystem there. I think there are more language barriers in France, and it's become a slightly isolated ecosystem, but nevertheless, they're seeing a huge boom there as well. And I think those trends will only continue, and partly because the government is backing those trends. I think, I mean, one thing worth mentioning on that is it's a little bit circular in that it's difficult to get investment into a region until you've had a number of unicorns come out of that region, or at least a few success stories to talk about. The UK and Europe generally is really benefiting from the fact that 10 years ago, it was difficult to name a UK unicorn. Today, there are, I think, close to 100. So as there are an increasing amount of unicorns, you have more investment into the UK ecosystem because people realize the potential, which then perpetuates itself and in turn creates more successful businesses coming out of it. And we're just seeing that cycle repeat itself. I think we're probably now in the second or third true cycle that we're seeing here in the UK. And bear in mind, this was basically a US industry up until maybe less than 15 years ago. So
may I add there something to it?
Sorry.
Also from a governmental perspective, VC is now not anymore seen as like a pure niche, and startups are not anymore just like a few guys in a garage. But governments are starting to understand that if they want to stay on top of the industry, or being like, as Germany, like one of the industrial countries in the world, staying ahead of it, governments understand now that startups are helping on the one hand, like the economy to stabilize, but also to have innovation really inside the country. So for example, Germany, and that's based also on the example of unicorns and the success stories which have been built in Europe, but also UK, US, wherever, that Germany has announced, I believe it was in November or December last year, that the so-called Future Fund, which is a 10 billion fund essentially given out by the government, where they are funding actually venture capital funds in order to fund startups. And I think it's the biggest governmental funding for VC funds which has been out there, at least in Europe in history. I'm not sure if there was something similar than that any time before. And those 10 billion are going into startups over the next 10 years. So $1 billion every year will be given out to venture capital funds in order to invest in startups. So that's a tremendous amount in order to fuel really innovation within a country or within a region, because it's actually not only for Germany, but it's for entire Europe.
Yeah, no, I agree. And Alexander, if it's okay with you, I'm going to breeze through the rest of the slides because we have 3 minutes left, but feel free to jump in at any point. One final point just to make on this slide, which I think is really, really interesting, is actually if you look at the reason why Europe is so strong on this list, you've got the States there where obviously great region to invest, but valuations are through the roof. China, really, really difficult place to invest. A lot of that investment is local money. In fact, I'd say I'd hazard a guess at 90+% of it is local money. Then you've got UK, India, which okay is growing but isn't a great place to invest yet. And then you've got Germany and France. So of really the regions on the list, you're seeing a pricing and general investment environment which is very conducive for growth in Europe as a whole. Next slide. I won't dwell on it, but I think this should be a great encouragement to anyone more technical out there. If you look at where investment into deep tech, which is deep technology companies who have real technology behind them rather than just a piece of software, the growing regions are in Europe. Everywhere else it's declining. Yeah, I think there is no better place to be going into deep tech than certainly in the UK, and it's true of Germany and France as well. And again, the government is behind a huge amount of that success because of their R&D support, and that's across Europe. This just reiterates the point how London has become central. You see the cities there are essentially the US, China, UK, and then you've got a few hotspots in Europe. Now, this is a really, really interesting trend which we've seen probably only over the last 18 months, 2 years in earnest, possibly even less, which is international funds, so top tier US funds primarily, investing significant capital into the UK tech ecosystem. And it's true across Europe, but it's particularly true, I think it's starting to spread to the rest of Europe, but it's certainly true in London now. And if you look at the likes of Sequoia, Index, Insight, they're all as good as it gets in the US, tier one funds, as it's called in the industry, and their focus at the moment is European investment because they realize the US is quite a saturated market. Final slide, because our time is up, is just on the stage of investment. And I think this is a fascinating one, particularly in light of the pandemic, and it alludes to what Alexandra and I were discussing earlier, which is the different stages of investments. So seed stage, which is very early idea stage before traction has been proved out, much riskier. We've actually seen investment decline through the pandemic. Whereas if you look later stage, which is the companies who have proven out their success, are growing well, we've seen investment increase. And I think as the large US funds continue to invest here, their appetite is really for the later stage ones, generally speaking. And I think where the UK at the moment needs to continue to be strong, as it was pre-pandemic, is in the seed stage. And that can be either from VC or from angels, so individual investors. But that is really the most important part of any ecosystem, because if you're not seeding the startups, then there is nothing there to grow. Alexandra, is there anything you want to add on any of them?
To be honest, no, all good from my side, nothing really to add, unless there are questions to it, which I can help to answer.
Great. Well, thank you very much. And I'm a bit conscious of time, so we've got a few questions, if that's okay with both of you. So firstly, we have one from somebody asking, is raising capital more difficult or finding good founders / startups? Like what's more difficult? To either of you.
So, sorry, like I might not have gotten exactly the question. Can you just repeat?
The question is raising capital more difficult or finding good startups more difficult?
So you're saying of like being a venture capital fund, if it's either harder to raise the capital for the venture
Yes.
capital fund
Yes.
or finding the good startups? Well, the answer probably is here a lawyer's answer. It depends. And it depends really on the circumstances the VC fund is in it, in my opinion. If it's like a early VC fund, which also might not have had yet a lot of track record, or raising the funds is the first big challenge. The second big challenge is finding them in the startups once the funding is there. And then the venture capital fund is building up its track record. So when they have like a successful track record, but raising the funds gets, I believe, slightly easier. But on the other hand, and then you might be raising more money, so you will be investing in later stages, but then you might be suddenly competing with other venture capital funds, which might have like a certain name, a certain reputation. And if there is a good startup, they might be overprescribed, so they might have actually more funding than they need, or more funding offers than they need. So getting into those deals is then really the art, how to convince the startups. I don't know, Dan, what do you think about that?
Yeah, I generally agree with that. I think the irony is tier one fundraising is probably quite easy. Tier one deals are quite difficult. So, yeah, every investment you make, you're sure you're investing in the best founders in the world, and that's why you're making the investment. So if someone asks you, is it difficult to find? Your answer will be no, because you think you're always investing into good things. But I totally agree with Alexander's point, is that if you're an early stage VC, if you're a young VC without a track record, it's going to be extremely hard to raise capital. If you are competing on tier one deals, I think it's equally difficult to make sure you're in the round, unless you're really at the peak of the industry. So I mean, I would say it's probably more difficult on the fundraising side, certainly when you're building in venture capital, than it is in finding good companies.
We have another one here, and I think you mentioned it a little bit earlier, Dan, but maybe both of you can build on it a bit. And it says, do you see European valuations converging to US levels as a trend, or will regional disconnects continue for the foreseeable future?
So my view on it is they're definitely converging, but there is still a very significant gap. My opinion, and I may well be wrong, is that there does deserve to be a gap, and that they will never entirely converge. And the reason for that is the difference in markets. So when you see a US startup and they're on the right growth trajectory, and you believe they will grow, the natural market is so much larger than it is in Europe. For a European startup, with fantastic traction in the UK, who then needs to grow geographically, it's a real challenge, because they're going to different cultures, different languages. Even if they're going to the States, it's a really, really tough market for a European startup to crack. So I think that there is a big gap. It is converging, but I think there will always remain a gap between them.
We have another one, which is the importance of exit plans. So are exit plans necessary when VCs are making decisions? Maybe Alexander.
To be honest, I think it's always good to show a VC that there is a potential exit strategy in place, even though it also, again, depends much more at the growth stage of that startup, because having an exit strategy is great, but if you have not even yet proven a product market fit, if you have not yet even developed maybe some sort of prototype or first platform, first website, whatever. Speaking about exits, I think it's still far away. Still, I think it's good to say, hey, we are in that industry. If we are growing what we are growing, and we might be a potential target for this or this type of company to acquire us. Yes, that might be the case. I think it might become more interesting at a later stage where like the exit is coming much closer to it. But at the same time, I guess at that stage also the exit potential is quite obvious already. So it's not anymore even a strategy. It's something which is in the clear way of the startup. So I think, yeah, that's my take on that.
Yeah, I generally agree. I think it's the only important factor for me when looking at an exit is timing, right? There are, generally speaking, when you look at a startup, it's in an industry you know and understand, or if you don't, you've learned to know it and understand it, and you will have your own views on what an exit could or should look like in the industry. Now, what's important is for the founder to be telling you, A, I'm in this for the long term, but B, when they see a realistic exit from their perspective. You know, there are some people who want to hold a business for life. That's not investable, right? There are others who want to get out in 2-3 years. That's also not investable, right? You need someone who, you know, is aligned in your way of thinking of their intentions for the business. But if I've been pitched many businesses where they've told me, yeah, I'm going to grow this to X stage, and then these people will have to acquire me. And for me, that just doesn't, it doesn't hold any water, because you should be growing this as a business in its own right. And if it's a good business in its own right, it's investable. If you're growing it with a view to acquisition, you shouldn't be basing it on what a third party may or may not do in the future.
I'm very conscious of time, so I've got one last question, and maybe if you could try and give a 30-second answer, if that's possible. So that would be, what do you see as the biggest challenge facing your sector going forward? And if we start with Dan on this one.
I think the biggest challenge is going to be from a geographic perspective. The last couple of years has showed us that globalization, as we knew it a few years ago, isn't necessarily here to stay. And I think it will become increasingly difficult for startups to, particularly from the UK, to grow geographically. So Europe is becoming more difficult. China has always been difficult, but is now possibly even more so than ever. The US under Trump was becoming difficult, but yeah, so I think for a UK business, they need to give real thought about what their geographic growth strategy should be. And I don't think there is yet a right answer for a UK or European business.
Alexander?
To be honest, to keep it short and looking at your timing, yep. I agree to 100% with Dan here. So I think like the geographical expansion, the geographical model you're looking into when growing your business is fundamental. And therefore, that also one of the tricky parts here, to be honest, to consider.
Well, great. Well, thank you both very much. I know you're both very busy, so everyone really appreciates you taking the time to do this and answering all our questions and giving us a kind of a deeper insight into the industry. I'd just like to say for everyone watching today, please feel free to check us out on social media for updates and more events in the future. And if you have any questions or queries, don't hesitate to reach out and ask us. But thank you once again to both Dan and Alexander for taking the time to do this. We all really, really appreciate their time. Thank you very much.
And a shout out for Alexander's TikTok account as well. He's a big superstar there, so you should all check him out too.
Thanks, Dan.
Anytime.
Great.
Thanks, everyone.
Thank you, everybody. Bye-bye.
Thank you.